In this session, I'm going to look at the mechanics of financial reporting. So, how are the financial statements typically prepared? What are the key points to remember while preparing the financial statements? So, initially, I would look at the various business activities and how they are typically classified, or to simply put, the different classification of the business activities. You could look at three major categories. One is the operations activity of the business, which is more to do with the core business. For an automobile manufacturing company, the operations part is buying and selling the automobiles, buying the spare parts, assembling, and then preparing a finished product and selling it. So these kind of operations, these kind of activities related to the operations side activities. Then every company has investment related activities, majorly to do with buying and selling of the assets, buying and selling properties, plants, equipments, vehicles, or even investing in other companies. Buying the shares of other companies, buying the bonds of other issuers. All these things go as a part of investment activities of the company. Then we talk about financing activities, majorly to do with raising capital, right? Raising capital in the form of equity, debt, preferred stock, different modes of financing the activities, financing the business, and the payments towards the financing activities. So, any company's business activities get divided into three major activities: operations, investment, and financing. So, all these activities all these activities should be reported as a part of the financial statements. So all these three, there should be different kinds of mechanisms to report all these activities in the financial statements. There should be a mechanism for every activity to be reported. Nothing can be omitted. Every transaction needs to be reported in some form or the other in the financial statements, right? So understanding of the different business activities and how they get represented in the financial statements is the core aspect of this particular session. So now that we know the various financial activities or financial major business activities of the firm, I'm more interested in seeing what are the typical constituents or the elements of a financial statement. Right? Whenever we talk about the financial statements, what are the key constituents of that financial statements? One. And what are the key balancing parts of the financial statements? Are typically what is the accounting equation. So I want to look at the key accounting equation in this particular session. Also, I want to look at how the entries are typically made in the financial statements, the typical accounting process, wherein we would we would clearly discuss what is called as a double entry accounting system. So we'll try to understand that particular process, which actually is the basis for accounting records and finally the preparation of the financial statements. The concept of accruals in the scope of accounting, and what are the kind of adjustments that are typically being made for the financial statements. This is one more area. And the accounting system is something which we will try to understand here. When I say accounting system, the typical flow of information, right from the transaction entry on a day-to-day basis, day-to-day based transaction entry to the preparation of the financial statements. How are the various entries made at what point in time and how they finally translate into the financial statement? And finally, what is the care that has to be taken by the analysts in case they are using this financial statements for the valuation and the analysis of the securities? What are the key steps they need to look at if they are using this financial statements for evaluating the securities? So these are the key things that we are going to cover. So initially, starting off with understanding the key elements of the financial statements, key constituents of the financial statement. When I'm talking of key elements, as a part of the balance sheet, I find three key elements. One is the assets, two, the liabilities, and three, the owner's equity. Three major elements of the balance sheet or the statement of financial position, and then I see two major elements associated with the income statement. One is the revenue, two is the expenses. So these five are typically called as the elements of the financial statements. Now, within each of these elements, we see there are different kinds of accounts. Within assets, there are different kinds of accounts. Within liabilities, there are different kinds of accounts. And when I'm using the word accounts, these are those kind of records for where the transactions are typically recorded. So different kinds of headings under which the transactions are recorded, those are called as accounts. And for each account, there may or may not exist a contra account. When we say contra account, it's a negative adjustment to this particular account. So probably when I am looking at accounts receivable, means I've sold something to a customer on credit and he is yet to pay. So all these credit based transactions, credit based sales that have been done and the outstanding that is to be received, they are treated in an account called accounts receivable. So whenever a sales is being done on credit, we make sure that a corresponding entry is made in an accounts receivable account because we are yet to receive cash from that customer. But if I'm sensing at a later point that this amount will not be received, this amount will be a bad debt, then what I simply do is I adjust this accounts receivables account by the amount of bad debt, by the amount which I feel I may not be able to receive because of the default of the customer. So the bad debt is treated as a contra account to the accounts receivables account. So like this, we have different kinds of accounts under each of these under each of these elements of the financial statement, we find more than one account of different kinds under which the transactions are typically recorded. Now, a few of these accounts are grouped. A few of these accounts are typically grouped, and the group of accounts with a group heading is typically presented in the financial statement, which means the financial statement does not contain all the accounts, but it typically contains a group of accounts grouped with one unique name. So probably it's like there could be a group called inventory, but under this inventory, there could be various accounts. There could be a raw materials account. There could be a semi-finished goods account. There could be a finished goods account. There could be various accounts contributing to the inventory. But all these accounts are grouped together to form the inventory account in the balance sheet. So what we could see is, from an elements perspective, there are five. Underneath each element there are a set of accounts, and each account is the header under which the transactions will be recorded, and each of these accounts can be grouped, and that group name is what is represented as a part of the balance sheet or the income statement. So the list of all these accounts without any kind of grouping is what we call as chart of accounts. It's like I'm having a big chart of all the accounts that are applicable to this particular firm, which means all these five of them will be grouped into one of these five elements. All these accounts are associated with one of these five elements, and are and may be grouped from the perspective of presentation in the financial statement, right? So now what we can do is we can try to understand each of these elements separately. Let's say assets. What are the key accounts that go as a part of the assets? So we have already discussed that assets are nothing but those resources which are owned and controlled by the firm, right? All those resources which are owned and controlled by the firm, they all get treated as assets. Some of them, just to list: cash. Then we talk about cash equivalent, something that can be converted into cash within 90 days. 90 days securities, 90 days or below maturing securities are typically considered as cash equivalents. Then we talk about the accounts receivables. This is one more account, as we just now discussed: sell to sales on credit and the amount yet to be collected. So that is considered as accounts receivables account. That is also an asset for the company. Then we can also look at inventory. Accounts receivables can have a contra account, as we just now discussed. A bad debt expense could be a contra account for accounts receivables. Then inventory, again, this is the kind of raw materials or work in progress or finished goods that are there with the company. Even this could have obsolete inventory as a contra account that could reduce the value of this inventory. I could also look at the prepaid expenses, means expenses for which the cash payment has already happened, but the delivery but the good or service not yet received, means it's like advance payment done but the service or the good not yet received, which means that's an expense not for this period but for the next future periods. So, which means today it's an asset because we have already paid for it. So, it becomes an expense on a future date, but because the payment of it has already been done, even that is treated as an asset. Then the property, plant and equipment, all these things which are necessary for running the business, Even the investments that have been typically made to purchase them is going as a part of the asset, because they are the ones which are owned by the company and controlled by the company. And any kind of usage part of all these property, plant, whatever is the proportion of their usage that has been done, that is the contra account, which is typically called as accumulated depreciation. That's a contra account to this particular account called property, plant and equipment. Then we can also have investments, whatever is the investment the company has made in other companies, or purchasing the bonds of that particular companies. All those things go as a part of investment. They are not in form of plant properties which are useful for running the operations of the business. Then there could be an entity called deferred tax assets. We'll discuss about these things slightly at a later point in time. So that could be one more heading that can go under the assets. And there could be intangible assets as well. Those kind of assets, those kind of resources which do not have physical form, but they still give value to the firm, like patents, for which there is a cost that was involved, but they can't be in a physical form. The software, copyrights, all these things, they are not in a physical form, but at the same time they give some kind of benefit to the firm in future. They are something which are owned by the firm and controlled by the firm. So all these transactions that happen with respect to each of these accounts, they would be placed under the category of assets in the financial statements or the balance sheet. Similarly, when I start looking at liabilities, we find different kinds of accounts that go as a part of liabilities. The most common one being accounts payable, which is more like I have purchased the raw material on credit, and the company is yet to pay to the vendor. All those things where the payment is not yet happened, they are treated as a part of the accounts payables account. Similarly, there could be a short-term loans or short-term debt of the firm, or there could be a long-term debt. Borrowings done by the company from the bank or any other source for less than 1 year is treated as a part of short-term loans or short-term debt, and if it is greater than 1 year, it is treated as a part of long-term debt or long-term loans. Similarly, there could be something like wages payable, the amount, the salaries that are still pending to be paid to the employees. Then there could be tax payable, the tax that was incurred for the previous year but not yet paid, even that could come, right? Or there could be a few more things like interest payable, the interest that is corresponding to the previous period but not yet paid. And there could be areas like unearned revenues. That's not a revenue for the current period, but it would be the revenue for the future periods. So you have received the cash in advance. Cash is received in advance, but good not yet delivered, or service not yet performed, which means that's not your current revenue, that's your future revenue. So anything that is a part of the future revenue in the current period, we'll treat it as unearned revenue under the heading of the liabilities itself. So all these are different forms of accounts that could typically constitute the liabilities. Similarly, when I talk of owner's equity, which is one more major area, major element of the financial statement, here we talk about the share capital, which is the capital that is contributed by the owner, which constitutes the par value of the stock. And anything that is paid in premium to acquire the share, we'll call it as additional paid in capital. Any additional over the par value. So typically it might be the case that the par value of the share is $10, but it is sold in the market at $50 per share. Then $10 will go as a part of par value, which is the share capital part, but the premium, which is $40 per share, will go as a part of additional paid in capital. And there could be a treasury stock, especially that particular set of shares which are bought back by the company, resulting in a reduction in the number of shares. This would be a negative account, which means it's a contra account to the additional paid in capital. So even that could constitute the owner's equity. Then we are talking about retained earnings. So the word itself is saying the earnings or the profit of the company right from the beginning, the profits of the company right from the beginning that are not yet distributed in the form of dividend. The company has retained that much amount till date without paying the dividends to the investors. So whatever is that particular profit which has been accumulated till date without paying in the form of a dividend is typically called as retained earning. Even that is also a form of a capital that goes as a part of the owner's equity. Then we talk about other comprehensive income, which is one more heading under, which is one more account under the owner's equity, wherein we see the changes that are coming purely because of foreign currency translation changes, or some kind of adjustments that are coming up because of the valuation differences, or any kind of unrealized gains to reflect the fair value concept of accounting. Any kind of unrealized gains that are typically coming up, even those are treated as a part of the other comprehensive income. All these things would be discussed in detail as we move further, but just trying to understand on a broad scale the various entries that go as a part of the different elements of the financial statements. Similarly, when I look at the income statement, we say that the two major elements that are constituting is one, the revenues. The key element that goes into the revenues is the sales, selling of the core products of the company, which come from day-to-day activities, day-to-day products purchased, services rendered, whatever the services rendered, and whatever is the fee collected for them, whatever the product sold, whatever is the price collected for them, all that goes as a part of the sales activity under the heading of revenues. Then there could be some kind of gains, especially if some of the assets are sold off at a profit. That gain is treated as a part of the gains on the sale of the asset. So anything that is more to do with the operations activity, any kind of gains that are coming out because of buying or selling of those kind of assets which are associated with the operating activity, I can treat them as gains. Then there could be other income or the investment income, especially with respect to the investment activity that the company has made in the other company's stocks or bonds or something. The dividend income, the interest income that comes from those investments is treated as a part of other income or the investment income. Similarly, on the other side, we could have the expenses element, which could contain different kinds of expenses accounts like cost of goods that are sold, whatever the goods that are sold, what is the cost associated with them, the selling expenses, administration expenses, marketing expenses, all those kinds of expenses that are associated, which again are related to the goods that are typically sold, even those get treated as expenses. Then there is a broader expense called depreciation, which is more and more associated with the usage of the fixed assets, usage of the property, plant, and equipment, what proportion of it has been used till now, even the intangibles which have a limited life, what proportion of it has been used till now. That is what is going as a part of the depreciation expense. Then we talk about the tax expense for this particular period. Then we talk about the interest or a financial cost associated with the particular period, and any kind of losses that are coming out because of the transaction, selling of the asset, selling of investment, because of selling of some of the things which the company was using earlier, because of the selling off of them, whatever is the loss or the profit the company has incurred, that will go as a part of the losses account, which would again be captured under the expenses element itself. So, on a broader scale, we need to have a good understanding of different kinds of elements that constitute the financial statements, and what are the different kinds of accounts that go into each of these elements, and what are the kind of contra accounts that are there to each of these accounts. So a good understanding of this kind of a framework will help us in making the entries into the financial statement quite comfortably. All right, now that we know all the five major elements, a few things which we need to understand as the relationship between these five elements, which typically boils down to the accounting equation. The relationship between these five elements comes out to the accounting equation. On a broader scale, with respect to the balance sheet, we say assets equal to liabilities plus owner's equity. But we can also write it as the owner's equity can be written as contributed capital plus retained earnings. Now the retained earnings are as of the end of the period. So the way we can write it is liabilities plus contributed capital plus retained earnings at the beginning of the period plus revenues generated during the period minus the expenses during the period, revenues minus expenses minus the dividend. That is what is contributing to the retained earnings at the end of the period, because whatever is the revenue that is generated during the period, expenses, which is giving me net income, out of that net income, some portion of it is paid in the form of dividend and the remaining portion is reinvested back. So that reinvested back is the additional retained earning. So whatever was the retained earning until the beginning of the period plus the new retained earning exclusive to this specific period put together is coming out to the retained earning that is going to be there at the end of the period. So overall it can come out as the joining all the five elements, I can very well write assets equal to liabilities plus the owner's equity. It can be broken down into the retained earnings at the beginning of the period plus the contributed capital plus retained earnings at the beginning of the period plus revenue generated during the period minus expenses incurred during the period minus the dividends that are paid during the period. This is what is the broad or the broadest form of the accounting equation, which has to be met in all conditions. This kind of this equation should be balanced. The asset should be balanced with the summation of all these various elements that are there on the right hand side, and that equation, it has to be met in all cases. And to meet that, we are following what is called as the double entry accounting system. When I say double entry accounting, every transaction that we are making, every transaction that we are making, it gets updated at least in two accounts. Any entry that we are making, it gets entered in at least two accounts. The recording of it has to happen in at least two accounts. And it should so happen that if the transaction has resulted in an increase in one asset account, then the same side of the other side of the same transaction should result in some other asset account getting decreased by the similar amount, or a liabilities account being increased by the similar account, which means, or the owner's equity account being increased by similar account, or a combination of this and this being increased by similar account. So that's where we are saying any increase in an asset account should result in a corresponding decrease in other asset account, or a corresponding increase in all these accounts put together. So that is the kind of entries that we need to be looking at for every transaction that is being made. Just for example, if I am looking at a transaction, buy a vehicle for 100,000 bucks, cash payment. Now, what are the accounts that are getting affected? Yes, I am paying cash. So my cash is actually going down by 100,000. But I'm getting a vehicle. Vehicle is a part of the property, plant and equipment. This is getting increased by 100,000. Now this is an asset, this is an asset. A decrease in the asset by 100,000 resulting in an increase in asset by another 100,000, overall balancing off. But if the same thing, instead of cash, if I say I have bought it on credit, then what could happen? Buy a vehicle for 100,000 on credit. So I'm yet to pay, which means that's a liability for me. So my accounts payable will increase by 100,000 bucks because I'm yet to pay. But because I have got the vehicle, my vehicle, which is the property, plant and equipment, is increased by 100,000 bucks. So my asset is increased by 100,000, my liability is increased by 100,000. So that is what is the double entry. And let's say when I have paid, when I pay for this, until I pay, this is what is the accounting entry. But the day on which I pay, because my cash will go down and the same accounts payable will go down. Now it's no more a payable. So asset is going down, the liability is also going down accordingly. So every transaction you should visualize that it is affecting at least two or more accounts. And because it is affecting two or more accounts, probably it should affect both on same side assets, or both on liabilities and owners equity, one with a positive and other with a negative, or it should affect one asset and one liability account, both of them resulting in a positive or both of them resulting in a negative. So such kind of accounting adjustments or entries have to be made, and this is a standard with respect to every accounting entry mechanism, which will definitely result in the accounting equation being satisfied in all the cases. If this double entry based accounting mechanism is followed religiously, we will find that the accounting equation is met in all the cases. So that's an important, essential point to remember while preparing the financial statements. The double entry accounting system cannot be ignored at all, right? Another important concept that is worth looking at in this session is the concept of accruals. What is this accruals altogether? See, in general, when I talk about the revenues or the expenses, what we see is the accounting concept simply says the revenue needs to be recorded when the company actually earns it. When I say earns it, when it has really rendered the service or it has sold the good. Only then it should recognize the revenue in the income statement. So it has nothing to do with the timing of cash. It might have received the cash for that much in advance, or it may be receiving the cash for that much at a later date on a credit basis. So this part should not matter much for recognition of the revenues. The company should record its revenues in the financial statement when it really earns it. Similarly, it says that the expense needs to be recognized in the income statement when the company has really incurred the expense, not when it has paid for it, or not the timing of the cash. It may be paying for it in advance, or it may be paying for that particular expense at a later date. So because of this particular concept of accounting for revenues and expenses not matching with the timing of the cash payments or receipts, there is a need for the accruals. So the entries that are getting created to address this particular mismatch between the revenues and the expenses recording time and the time at which the cash is getting paid or received. So this is where the accrual entries are coming into the financial statements, and four combinations. For the revenues, with respect to the revenues, if I see that the cash is in advance, cash is received in advance, or cash is received at a later stage. Similarly, for expenses also the same thing. Cash is paid in advance, cash is paid later. So what does this mean here? In case of revenues, cash is received in advance. Means you received the company has received the cash but did not perform its revenue, perform its selling of the good. So it can't be a revenue in the current period. Whatever this good or service is, it's a revenue for the future. So for the current period, it would be treated as unearned revenue. For the current period, it would be treated as unearned revenue, especially when it has received the cash in advance and it has not yet provided the good or service, which means it's a liability. So liability is going to increase under the heading of unearned revenue, and because it has received the cash account is going to increase right away, which is an asset account, and the unearned revenue account, which is a liability account, is going to increase by a similar quantity. and at a later date when the cash when the service is recognized, the revenue account is going to be increased. So revenue account is the right hand side of the accounting equation. So if the revenue account is getting increased, and the unearned revenue, which is the liability account, is going to be decreased. So these two are the transactions that are changing when the service is actually performed, or the good is actually sold, and no change in the assets. There could be some cases where the good or service is delivered, but the cash is coming at a later point. In that case, we treat them as accrued revenue. Revenue is already recognized, but the cash is not yet obtained. So whatever the cash that is yet to come, we can note it as a part of accounts receivables. So any good or service that the company has delivered, the revenue account is going to go up because it has already delivered the good or service. So on the right hand side of the accounts equation, there is an up, and on the asset side, the account receivables is going to go up by a similar amount. So this is what is the transaction that happens now. At a later date, when the cash is received, the cash account is going to go up, the accounts receivable account is going to go down, resulting again in the balancing, because both of them are treated as a part of assets. The same logic again, okay, in terms of expenses, advance payment of the cash is done. So, which means the actual expense is not for the future period, it's an expense, is not for the current period, actual expense is for the future. So, initially there is a cash payment, and the expense would be at a later date, which means right now it's an asset, and it would be treated as prepaid expenses under the heading of prepaid expenses. So whatever the cash that has been paid now will result in a cash typically going down, prepaid expenses, which is an asset, which will go up by the same extent. So again, there is a drop in cash, there is an increase in the prepaid, again resulting in a balancing. At a later date, when the expense is really incurred, the expense is increased. Expense is increased should result in the left hand side typically going down. So the prepaid expenses is going to go down. So in that accounting equation, expenses are increasing means net income is decreasing. Net income is decreasing results in retained earnings decreasing. So owner's equity part typically decreasing. So on the asset side, I could simply see that the prepaid expenses typically go down. Similarly, the fourth combination is when I have already incurred the expense, but the cash payment is happening at a later date, which means I'm yet to pay cash. Yet to pay cash is going as accounts payable or accrued expenses. If it is for the trade vendors, I can call it as accounts payable. In general, this accrual is the accrued expenses. So initially the expense is already incurred. So expenses are going down. Expenses are going down in the sense the retained earnings, net income will, expenses up, they have gone, if expenses are already incurred, so expenses are up, which means net income is down, the retained earnings are down, the owner's equity portion is typically down, and there is an accounts payable, which is a liability, which is up. So liability is up, owner's equity is down, again a balancing. But on that day, the cash payment typically happens, the cash is down, the accounts payable is also down. So one asset is down, one liability is down, again resulting in a balancing. So these are the four different kinds of accruals that we can see because of the timing difference between the recognition of the revenue or the expense in the income statement and the timing of the cash that is received or paid corresponding to it. So in all these four, what we could typically see is the earliest that is occurring. In some cases, the cash payment is occurring the earliest, right? In some cases, the good delivery is occurring at the earliest. In some cases, the expense is incurred at the earliest. Whatever it is, whichever is the one that is happening at the earliest, at that particular point in time, we are making an accounting entry. Right at that particular point in time, we are making an accounting entry. At a later point, when the settlement of that typically happens, when the second event occurs, an offsetting transaction is typically being performed. So at the earliest of the occurrences, one transaction is typically getting performed and couple of entries coming up accordingly, and at a later point when the settlement of that particular transaction is happening at a later date, the offsetting is being performed. But the prime intention is at the end, whether it is revenue or expense, try to represent it in the financial statement during that period to which it is more and more appropriate, not the period in which you have received the cash or you have paid the cash, but try to recognize it during the period which it really corresponds to. That is the major intention behind using the accrual process with respect to the assets and the liabilities, creating accrued assets and the liabilities. So this is one major concept that we need to be comfortable with, and a few other adjustments that typically get made to the financial statements. See, what we have to understand is majority of the assets that are there in the financial statement for the quite some time, they have been measured on their historical basis itself. Whatever are the various assets, historical basis cost. So the cost at which this particular asset has been acquired long back, that is the cost that is reflected in the financial statement and not the current fair market price. So in general, that used to be the case. But with the changing accounting standards, especially we'll discuss about what is called as International Financial Reporting Standard, there has been a lot of focus towards the fair market value of the assets. So the fair value of the assets, which result in making adjustments, doing the revaluation of the asset, making an adjustment to the market value of the asset. So increasing the value of the asset accordingly, if at all there is an increase, or decreasing the value of the asset accordingly if there is a decrease. So these adjustments on the asset side, there could be an increase or a decrease because of this revaluation that is typically happening, which means correspondingly there could be an increase in the liability or the owner's equity, either increase or decrease accordingly has to typically come up. So in this, especially a few of these transactions get under this heading of other comprehensive income in the owner's equity section, and in some cases it could result directly through the income statement, resulting in the expenses or in the revenues. So they are adjusted and from there come through the retained earnings portion in the owner's equity section. So any of the routes, that is directly resulting in some kind of adjustments being made to the financial statements to reflect the fair value or the reality value of those particular assets. right? Now we can look at a few important relationships that exist between the various financial statements, how the linkage between the various financial statements happen. So for that, I would take up a few financial statements, right? One single company's financial statement, the income statement for the year. Okay, starting with the sales or the revenues, cost of goods sold is an expense, administrative expenses, depreciation for the year is an expense, financial expenses is an expense. So overall, the total expenses being the summation of all these four, resulting in total expenses of this much. Sales minus the total expenses resulting in operating income. So these are the various operations activities of the company displayed as a part of up to here operating income. Then I have something to do with the investment activities. There is a gain on the sale of the asset. The gains are treated as a part of the revenues. So there is a gain on the sale of the asset which has resulted in a total income before the tax to be the summation of these two. Then there is a tax that is applied on it, resulting in a net income of this much. Out of this net income, the company has declared a dividend of this much, resulting in the difference between these two, which is the retained earning that is going to be added on to the balance sheet. Now, if I see a few important relationships here, yes, this is a retained earning 11,387. So when I look at the balance sheet, okay, there is a year one, which is at the end of the last year, which is the beginning of the current financial year. These are the numbers: cash, accounts receivables, inventory. These are some of the assets that are there. The land, the plant and equipment. It has a contra account called accumulated depreciation. So the subtraction of these two will result in a net plant which is 57,000 minus 8,500, 49,000. Goodwill, which is another asset. So total assets coming out to 96,000 in at the end of year 1 and 106,000 at the end of year 2. The same way I could look at a few liabilities: accounts payables, administrative expenses payable, interest payable, tax payable, dividend payable, long-term debt. So all these are going as a part of operating activities. Then I have a few financing activities: the long-term debt, the deferred tax, the common stock, which is the equity capital, and the retained earnings, the portion of the profit which has not been paid till date. So similarly, these are the numbers associated with the second year. Now, few important relationships that I should see. Okay, this is a retained earning for the year 1. This is a retained earning at the end of year 2. The difference in the retained earnings at the end of year 2 minus year 1, this should match exactly with the retained earning that is coming from the income statement. Though the retained earning will not be shown in the income statement, though the retained earning will not be shown in the income statement, simply the difference between the net income and the dividend declared, whatever is the difference between these two, should exactly match the difference between these two. So that is one key relationship that we see between the balance sheet and the income statement. Okay, so all I can write is net income minus the dividend of the income statement. I should typically see it as equal to retained earning of the end of the period minus retained earnings at the beginning of the period. So this kind of equality should very much be seen. Then the second important check that I can typically see is here, the accumulated depreciation in the balance sheet. accumulated depreciation in the balance sheet for the ending period should be equal to accumulated depreciation in the balance sheet for the beginning of the period plus the depreciation of the year that is coming from the income statement. So it's like the difference between the accumulated depreciation here and the accumulated depreciation here. 13,900 minus 8,500 should match the depreciation, which is 5,400. That's one more interrelationship that we need to be comfortable with. Then I could see a cash flow statement being constructed. We'll discuss each of these things separately, but we are just looking at the relationship. The final cash flow, the total final cash flow that is coming out, I should see that it is different. It should match with the cash flow at the end of the period minus the cash at the beginning of the period from the balance sheet. So the difference between these two should match exactly this one. So that is one more relationship. The cash flow that we are getting through the cash flow statement should match the difference between the cash that is coming from the balance sheet. One more important relationship. So if I simply see the difference here, okay, the difference here is 24,913. Even here the value is 24,913, which means there is a kind of synchronization between here you could see there is a kind of a synchronization between the income statement and the balance sheet, one through the retained earnings and two between the depreciation and the accumulated depreciation of the balance sheet using so these two are related, then these two are related, right? And I see these two are also related, right? This is one more relationship that I could see as the relationship between the various financial statements. And a statement of owner's equity typically talking of the big initial period capital and retained earnings, which are matched with these two. During the period, whatever here we would only be interested in we would only be interested in the transactions that happen with the transactions that happen with the shareholders, which are resulting in the payment of dividends and the final amount that has been carried forward as a part of the retained earnings. So these are the ending of the period retained earnings, resulting in the change in the owner's equity in this particular manner. So typically we see that these are the four different financial statements that are presented and submitted. Just giving you a simple snapshot. Of course, each of these things, every element we will try discussing as we move further at later points in time. We can even take this similar example to understand a lot of other elements of the other even more deeper aspects of the financial statement. But for now, we can simply understand that these are the three key relationships that I see which bond the balance sheet, the income statement, and the cash flow statement, and always resulting in the balancing of the assets and the liabilities accordingly. So these are some of the important connectors which keep the accounting equation always balanced and and result in any data changes resulting in the updation of the balancing portion accordingly. So while developing the financial statement, these aspects need to be kept in mind, which act as the balancing numbers for the financial statements. Right, this relationship needs to be kept in mind quite comfortably. Then I am looking at the accounting system, the typical the typical accounting system that is followed within majority of the organizations, where initially they start off with recording every transaction that happens, whether it is cash based or credit based, every transaction that happens on a daily basis is represented in the journals. So they talk about each of the accounts, by how much they are changing and when they are changing. So the timing, the date, and the amount, all these are clearly specified in the journals. So all these are typically arranged in the order of chronology, date wise arrangement, typically called as a general journal. So in a journal, it is more of date-wise recording of the transactions and date-wise grouping of the transactions. But if these same transactions are regrouped account-wise instead of date-wise, we typically call them as a ledger. If the accounts are typically if the transactions are typically grouped account wise, not the date wise, it goes as a part of the general ledger. So it's basically a sorting of the general journal entries in the form of based on the account. Then at the end of the accounting period, sometimes it could be a quarterly or it could be annual, whatever is the accounting period. At the end of the accounting period, there is a kind of a summarization of every account, summary of each account. So probably some kind of summation of all the values corresponding to each account is performed, and that kind of account wise summarization is typically going into what is called as a trial balance. Account wise summarization is going into a trial balance. Any kind of adjustment that need to be done to it are typically performed, and what we come out with is the adjusted trial balance. So it is account wise summary, the net positives or the negatives corresponding to each of the accounts. That is what is going as a part of the trial balance, and one or more of the accounts from the trial balance are typically grouped to constitute the balance sheet or the income statement or the cash flow statement. These elements from the trial balance, adjusted trial balance, are typically grouped as per the reporting mechanism into the balance sheet or the income statement or the cash flow statement, which are the typical financial statement. And what we typically see is all these are internals to the company. An external person cannot view any of these. The journal is not accessible to an external person. The ledger is not accessible to an external person. The trial balance is not accessible to an external person. It's only the financial statements which are published as per the requirements, as per the requirement of SEC or as per the corporate governance process. It's only the financial statements that are published. So only these things need to be evaluated by the analyst to the core. Because this data is not available to the external analyst, it is the analyst should typically develop that skill uh, comparing and analyzing the financial statements that are published. So a good understanding of the concepts of accruals, all kinds of adjustments that are typically made, and any kind of assumptions that are being made, all these things need to be understood by the analyst very keenly and majority of these things are typically found in the footnotes to the financial statements or MD&A, management discussion and analysis. So a thorough workout of those aspects of the annual report will really help the analyst understand all these various concepts, which can help him to better understand or better evaluate the performance of the company and typically recommend it for the investment related decisions. And one more important use that the analyst can derive out of it is we should understand that all the assumptions that are typically being made, all the estimates that are typically being made, there is some amount of management discretion. Whatever the adjustment you are making, whatever the estimate you are making, you have to mention it as a part of the footnotes or MD and A. So there is a lot of management discretion angle that is coming up while preparing these assumptions and adjustments. So a thorough understanding of the process will help the analyst to really evaluate any kind of areas which require attention, or any assess any of those entries that are made which could be misrepresented by the management, where management might have typically got into some kind of fraud in terms of entering the data into those financial statements. So, a thorough understanding of the various elements, their accounts, and the estimates, the accrual processes, all these things typically help the analyst bring out the best possible evaluation of the financial health of a particular company, right? So these are the various aspects that go as a part of the various mechanisms associated with the financial reporting. A good understanding of them will definitely provide a good analysis and then a good valuation of that particular firm. All right.